Nichols, Matt Smith joining us this morning, lead oil analyst for the Americas at Kepler. Matt, good to have you with us. Good morning, and good to have you back on the show. Kind of a muted reaction to the news. OPEC Sunday agreed to extend output cuts throughout next year.
Yeah, that's right, Ben. Although it does suggest to you, right, that if they hadn't extended some of those cuts until the end of next year, then we would have seen prices come off. And so they were perhaps aware of that. So they were trying to give something to the market here to lend that element of support. But there were really kind of three things to take away from yesterday's meeting, Ben, that were key. The first is that they have these additional voluntary cuts in place here. They've said that they could end those at the end of Q3. We don't expect that to happen. We've always expected them to extend them through at least the end of this year, but it does give them the wiggle room if prices do ramp up higher, which isn't likely, but it kind of gives them an out. The second piece is that UAE was given an additional 300,000 barrels a day in terms of their production quota for next year to appease them, essentially. And then the third piece was essentially Saudi calling out Iraq, Kazakhstan and Russia for non-compliance there. So there was a lot coming out of the meeting yesterday, but ultimately prices are just kind of ticking along flat here, right?
Well, we've been hearing about how these meetings have been somewhat contentious as of recent, but not as much buildup, I'd argue, into this one. Any read through in terms of the decision, Matt, as far as demand concerns with this?
This is the weird thing, though, Ben, right? Because when you look at the OPEC report, their demand growth for this year is at 2.2 million barrels a day, really strong. The IEA is looking at half of that demand growth, right? We personally are looking about 1.4, so they are
right
well higher than. Yeah. And even next year, they're looking at sort of 1.8 million barrels a day of demand growth. That doesn't quite jibe with them extending these production cuts right through the end of next year. The out that they have in terms of the supply coming off maybe in this voluntary cut into Q4, or if they do that early next year, is because we see non-OPEC supplied growth coming off. So that may give them the cover to be able to bring back more barrels. But ultimately, it feels like we're in very much a trading range here, and it's difficult to see how we get out of that.
You know, we've been arguing for a while that this trading range has been supportive of what we've seen in terms of stocks move higher, these all-time highs. We started the show off speaking to as far as the rally back and how the pullbacks have been somewhat limited, right? There haven't been a lot of headwinds out there, and investors continue to focus on the positive and really discount the negative. Crude, for that matter, has kind of discounted some of those geopolitical tensions, I feel like, and a lot of uncertainty in terms of China, right? The data's still mixed, no real lean one way or the other. Overnight, even as I look at the manufacturing data, the Caxton PMI number, manufacturing PMI, it upticked from 51.7 to 51.7 from 51.4, it looks like. They were looking for 51.6, so a little bit better than expected. But there were some other components here, and we'll get some more components, it looks like, tomorrow, or Wednesday. Some other components that have fallen back below 50, so kind of a mixed picture still out of China.
Absolutely. Just when you start to think that the data's looking weak out of China, you get that PMI number, which was the strongest since June 2022. And so, again, I think the situation with China, when you bring it back to oil, is that, yes, they're going to show demand growth this year. We're looking at about 350,000 barrels a day, but it's still not the demand growth that we've seen from them previously, right? And so there's kind of that easing in that demand growth as they become more of a developed nation and continue to struggle from an economic perspective there. The way that they're driving on their economy is just throwing gloops and lumps of stimulus at the economy, right? That's how they're kind of driving it on. And so we continue to see pockets of weakness coming through in the oil demand data from them. They're exporting products pretty strongly, which just signals that their domestic market is soft.
Matt, one of the products with the focus on oil, obviously geopolitical tensions, which have dominated the narrative there, and now being OPEC and obviously China a big part of the discussion as well. We've kind of lost our focus on natural gas. It's kind of slipped off the radar a little bit. What's the latest? What's been going on there?
Yeah, sure. So today we're around $2.70. And so as we had some rationalization in the market there, we had some producers taking some supply off. We saw prices increasing, and then they're bringing that back again. And so we're seeing prices come off again. And so big picture is we're kind of hanging out in this shoulder season kind of period. We're heading into the summer here, though, Ben. Hurricane season is a real concern. The demand side from the from electricity demand is going to be at a record again. But the real concern is that hurricane season is supposed to be hyperactive, some have described it as. And so that could really shake things up on the natural gas side of things. But ultimately, we just continue to remain mired in that $2 range. It's just not really budging.
And again, just to kind of hear you say in that range sort of ties me back to that crude component, obviously, tying into inflation, obviously, and not really feeding into concerns associated with it, especially as we've come off the extended levels that we saw just recently up around that $90 level when we tested, tied to, again, geopolitical tensions, but those were short-lived ultimately. And again, that retreat that we've seen has helped ease some of those concerns.
Yeah, and I think with oil, though, Ben, what we saw was global onshore oil inventories were building, and I think that caught some by surprise there. And so as we saw that increase coming through, that really provided some headwinds to the move higher. Okay. Yeah, it helped pull them back. That said, we're at this point now where you're driving into summer here. We're going to be seeing refiners running very hard. That's driving on demand for those oil barrels. And so that's really the bullish case going forward here as you see inventories drawing, as refiners run as hard as they can over the next few months. It's really what comes after that is going to be the biggest challenge.
Matt, all things considered, barring some unforeseen event, obviously, where do you see prices as we head into the second half of the year now?
Fairly balanced, Ben, honestly. So just as I mentioned there, in terms of the seasonal backdrop, it's fairly bullish, right? But on the flip side of it, you've seen Brent flirting with moving into contango in the first couple of months here. In the last week, you've seen the physical prices for crude looking softer. You've seen refining margins softening up a little bit too. And so there's this kind of battle between the bulls and bears. And that's what's keeping us essentially neutral here, it seems.
So maybe a little bit of increased demand here as we continue, but a market that's prepared for it, I guess one could argue, and gotten ahead of it potentially this time around. Matt Smith, appreciate you joining us again. Good to have you back on the show. I feel like it's been a while. Matt's the lead oil analyst for the Americas at Kepler.